I'm Natalie MacDonald, and it's time for the first Targets in Focus interview of the new trading week. Concerns over Spain are once again dominating the currency markets as investors trade on expectations that the country is moving closer to a full sovereign bailout. Reports also emerged over the weekend that the IMF has signalled to EU leaders in Brussels that it will no longer provide financial aid to the heavily indebted Greece. Talking me through his FX forecast today is Stuart Frost, Fund Manager at RWC Partners in London. Stuart, thanks for speaking to me today. Let's begin with the Euro-US dollar. This pair has opened at fresh lows this week following 3 weeks of successive losses, brought on by concerns that Spain may soon ask for a full sovereign bailout. The Spanish Treasury Minister, Cristobal Montoro, has stated that the country's recession will extend into next year. How does this bode on your predictions for the Euro-US dollar over the 1, 3 and 12-month period?
Well, obviously, it's quite negative, to say the least. We expect to see further declines in the euro against US dollars, specifically targeting the lows we saw in 2010, which is at 118.74. I think you have to remember the only thing that's going to slow the euro's decline is really repatriation of euro assets out of dollars, presumably from abroad, to actually cover losses on balance sheets, etc. So the euro's predicament is quite acute, to say the least. I mean, if you think about it, the euro has been as low as 0.83. So given the set of circumstances we continue to trade on, with record Spanish yields this morning, and bond yields obviously pushing lower, upon with US Treasuries pushing lower as well, I think that, it all suggests that euro-dollar should be a lot lower. The real question is the pace of the decline. Is it going to be rapid, or is it just going to be really just chipping away at the downside?
If we move on to the Australian dollar, US dollar, Eurozone's concerns have weighed on this pairing also, with Valencia asking for financial aid on Friday, appearing to cut short the mini rally of last week. But with the announcement that the Australian economy witnessed a higher producer price reading during the second quarter of 2012, where do you see this pair heading over the short, mid and long term period?
Well, obviously the Australian dollar is held up by yields, and with a bit of a yield grab going on around the world, it might suggest that the Aussie can stay reasonably firm. The downside risks on Aussie are really on commodity prices and emerging markets, and China more specifically. If you look at the state of the Chinese equity markets, they would seem to suggest that China is going to continue to slow, and demand for commodities is going to stay quite weak. I would suspect that if gold finally does crack, then the Aussie will go with it. But at the moment, we're sort of have a feeling that the Aussie will weaken, but not dramatically. Yield is still quite high in Australia, and it will underpin the currency overall. So we might see a sort of drift towards parity, maybe a touch lower. But there's been a lot of selling of euros and into Australian dollars, where obviously there's quite a big yield differential. So in that respect, the Aussie a little bit weak, but not excessively so, and will continue to attract investors from time to time. But if there really is a serious decline in commodity prices, and that means base metals, then it might well come under a little bit more pressure.
And lastly, if we take a look at the British pound US dollar, the pound fell 0.61% against the US dollar on Friday after it emerged that the UK's public sector net borrowing rose to £14.4 billion in June. Can we expect poor data from the UK to continue dominating this pair's movements, do you think?
Well, we think sterling will stay sort of in a range, really. There are the conflicting, obviously, factors involved here. Sterling, obviously, the data is not good. It's getting tied in with Europe an awful lot. On the flip side, it's a safe haven currency. Certainly, the capital flows into the currency have been quite extensive. If you look at the value of euro sterling in particular, where we are pushing some very, very serious levels down at 0.77, that's probably something that's going to stop a big sell-off in sterling dollar through 150. If we do see a big move into the dollar, then arguably, it is going to mean that sterling will suffer also against dollars. But, given the euro situation, we could see euro sterling really falling quite excessively, even beyond the levels we're talking about now. That could be 0.72 or something like that. But certainly, sterling at the moment is a little bit caught between safe haven currency and poor performance and poor figures. Having said that, UK exports are now actually more to the rest of the world than Europe, so there are other factors here that can help sterling out. And the market has generally been quite bearish position-wise on sterling against dollars, and it's not really a trade that's worked in the last 6 months.
Stuart, thanks very much for your insight. We look forward to speaking with you again soon. That's all we've got time for right now, but stay tuned to Dukascopy TV for more exclusive interviews and all of your technical analysis. Goodbye for now.